Hello and welcome to BloombergQuint. My guest today is Mr. Ankur Gupta, Managing Partner Head of India Real Estate at Brookfield. Brookfield is one of the largest institutional investors who is coming out with a REIT for its property in India, and that is expected to open sometime next week. Uh, thank you very much for joining us in BloombergQuint. To begin with, you have such a huge portfolio in India, but you're only starting your initial portfolio with just four properties. Why is that?
So it's a great question. Brookfield has been a prolific investor in the country over the past 7 years. Our commercial real estate portfolio has stretched from almost nothing in 2014 to more than 42 million square feet today. In our view, we are entering the REIT market in the country with Brookfield India Real Estate Trust. This will be a long-term vehicle for us, spanning several decades. We have seen the growth of REIT markets globally. We've been an active participant for several decades in developed markets such as the US, Canada, and other markets in public REIT management. We believe that the assets select themselves. We've chosen the highest quality, most stable assets to be part of the initial portfolio. And that being said, we expect this REIT to grow, and we have identified almost an equal size of assets as identified growth pipeline, where Brookfield is committed to grow this REIT in the near to medium term.
Ankur, we already have around two REITs already there. How do you see this REIT market growing? And are we trying to get is the REIT market in India mature enough, or still testing it with a small portfolio?
So I would want to compliment our market regulator that they've established a REIT regime in India that is very robust, that mirrors the mature markets that have today reached that stage where India is starting off. So while I cannot claim that with only the third REIT being the Brookfield India Real Estate Trust, the Indian market is mature enough. Just for comparison, the US REIT market, public and market and private market, is more than $5 trillion. So India has still a long way to go. But I would say the regulations that are in place in India would make that journey a really quick one. And India is at a stage in its commercial real estate cycle where high quality assets are being constructed, high quality assets are being leased, and the tenancy that we have in India is the best in the world.
Hmm. Also, I just wanted to get your thoughts on the identified assets and the right of first offer assets. Now, these, if you bring those in, your entire portfolio doubles almost. When do you expect that to come into your portfolio? Is there a timeline for that?
As I mentioned, assets select themselves. As those assets complete their development cycle, there is about 20% development that is nearing completion in the identified assets. The ROFO assets are a little bit further along in terms of when they would be stabilized. So as the assets become stabilized, they will be put to the REIT committee, the board, and the board will make its decisions, and the shareholders will ratify those decisions. So I expect that the normal development and leasing cycle, the REIT should be in a position to exercise on some of these opportunities in the near term. I'm not able to comment whether it's going to be 3 months or 6, but this should be a program that the REIT can embark upon within the first year itself.
I'm asking this because you have mentioned in your RSP or filing that you're looking at a 25% jump in net operating income to nearly 818 crores. So what does that jump assume? Does the identify assets and ROFO assets come as part of that, or is it only an organic one which you're talking about?
So that number refers to the organic growth. As you mentioned, our assets are very high quality. While they are very stable in terms of their current income, there is tremendous upside in same store growth of the net operating income. That is a result of two factors: the contractual escalations as well as mark to market of rentals, as we see 10 to 15 churn in this portfolio going into the future.
I just wanted to get your thoughts on the churn that is happening in the industry as well. We saw a very bad year, pandemic year last of 2020. We've seen a lot of IT companies also talking about new models of working from home. you have nearly 50% of your portfolio exposure to technology. And within that, if you look at the top three, Accenture, Cognizant, TCS, 46% of your lease rentals come from these three, and most of them, and these three have mentioned the fact that they are looking at a new model of working from home. So, what is what are the kind of risks associated with this change in model which you see? I also understand that people are asking for more space now because of COVID and other stuff. But if TCS is looking at a 25-25 model, where 25% of its workforce will work from offices by 2025, that also brings in limited demand for commercial real estate space.
Look, real estate houses the economy. There is a reason why people have collaborated at office spaces for several centuries. Our response to the pandemic is something that we should all be very proud of. We were able to maintain business continuity, not just for their local office, not just for the India business, but for large companies across the world. I think India stands very, very bright in how it has established and reinforced its position in the global services sector. The order pipeline of many of the names you took just now is solid, it's robust. Their business models are better today than they have ever been. And as these companies look to ramp up their growth engine, they would require spaces. As far as the work from home is concerned, it was required, it was mandatory, and it was the right thing to do to be able to contain and fight the COVID-19 pandemic. As the world sees the rollout of vaccine, I certainly believe that people will want to come back to offices. Our assets in India are 24/7 business operations. These are mission critical spaces for tenants such as Accenture, TCS, the names that you took. They are doing 24/7 operations. It's a very, very robust model for these companies to work out of. And I believe that the hybrid model of working has been in place even before the work from home became uh, a commonplace term over the past 12 months. People have tried with hybrid models. All of us take phone calls from home. All of us do some work from home. And whether the percentages are 25 or 15, I think the companies will need to really evaluate as they come out of the pandemic, ramp up their growth engines, and are on a path to growing their businesses as to what is the right operating model, whether it's 25% of workforce or whether people spend a few percentage of their time every week using flexi hours and flexi spaces.
Mm. Uh, Give me a sense of how this market also is evolving in terms of demand. You are present currently in four cities. These are key metros as well and business districts. Uh, how do you see demand for commercial real estate picking up in this? And with respect to yield, are we going to see an increase in yield from these assets going forward, or is it sometime it will take a few quarters before the yields come back to the pre-COVID level?
Our leasing pipeline is more than 1.5 million square feet today across these four assets. We own assets across the country, and the leasing discussions are extremely solid and certainly have been over the past several months. As I mentioned, commercial real estate houses the economy, and our assets are very well positioned in not just in the cities that they are present, but in the exact zip code that they are present in terms of infrastructure, ease of traveling to offices, and the entire 24/7 ecosystem, including amenities, gym, food court, creche, ambulance services, 24/7 on-site availability of doctors and paramedics. So the way I like to say it is our tenants and their employees, they live where they work, and our office parks across the country are very well positioned to deliver on that promise.
What about the demand? Is it coming back? What about yields? Is it coming back to pre-COVID level?
So as I mentioned, look, India was in almost a 9-month lockdown. Even then, the country did on an average about 50% of 2019 leases, and I'm referring to some of the research reports that I've read. So that's not a weak number to begin with in a year where for almost 3/4 of the year the entire country was facing lockdown situation. Our own portfolio of these four assets are seeing a demand in excess of 1.5 million square feet, and we don't have that much vacancy in our portfolio. So all parameters point towards reopening of the economy. And as a result of that, tenants looking to take spaces in high quality assets, which is something that I want to emphasize today, that high quality office spaces, great locations, tremendous infrastructure that institutional investors, operators like us provide, will be in demand and have been in solid demand throughout.
Mhm. You know, my other thing is about the debt reduction. I think you're raising around 3,800 crores, largely for reducing your debt. Uh, when you reduce the debt, what is the kind of trickle down that is expected, uh, so that you can bring in distribution for your investors?
So our distribution yield out of the gate will be between 7.95% to 7.98%. We are going in at roughly 18.5% loan to value pro forma for the IPO. And we believe that is a very robust capital structure that creates liquidity for the REIT to embark upon growth plans, as well as creates a lot of solidity behind the income stream. Our debt is AAA rated, and we expect that this REIT will be a very well managed capital structure for us and for our investors.
This distribution which you've mentioned, does it also factor in new assets as it come in? The rate will remain the same, or it may vary or may come down because of the acquisition cost or future debt which you may have to take for the acquisition.
So today, our stated cost of debt is about 7.15%. So the debt is the cost of debt is lower than our stated yield at the IPO pricing or at the IPO price band. So debt is accretive. We believe that the REIT should embark upon accretive acquisitions. So I expect that while the 7.95 to 7.98% yield is on the current portfolio, as the REIT does more acquisitions, the intention for this distribution yield would be to grow rather than compress.
Mm-hmm. Uh, what is the kind of capex requirement that you have to complete your under construction and future development projects?
So today in our portfolio, all of the assets that are in the initial portfolio are completed. We have a development pipeline and under construction portfolio that is really at very early stage. So we don't expect any capital requirement from operating cash flows. To the extent the REIT does developments, they will be through construction debt financing.
Okay. So you don't, you'll entirely go for construction debt finance for those developments basically there. One of the expectation was that, you recently completed the RMZ acquisition for $2 billion portfolio. We thought that it would be part of the REIT, but it's not. So is it also available to the REIT in a future date?
Our stated intention for the REIT is to grow. We've already made available 15 million square feet of assets from the Brookfield group, and as the REIT progresses its growth plans, it will look at future acquisitions, not just from the Brookfield group, but from the market available transactions as well.
Mm-hmm. Ankur, I know I'm running out of time, but my final question to you is that do you, as you hold one of the largest portfolio of real estate commercial assets, do you see commercial real estate coming back to the same level of pre-COVID in the next quarter or so? Do you have an outlook for the commercial real estate in terms of how it's going to pick up, irrespective of whether it's for Brookfield? I'm talking from an industry point of view.
Commercial real estate is contingent upon a number of factors: location, infrastructure, quality of sponsorship, and quality of management are all factors that influence commercial real estate. Long-term availability of capital is the key ingredient in being able to offer these amenities and keep upgrading these facilities for our tenants. Business models are evolving, tenants' requirements are changing. As one of the largest owners of office spaces, not just in the country, but globally, we have a bird's eye view of how formats are changing. India is at a great advantageous position. We have one of the lowest costs of doing business for global technology companies, services companies, large software development companies, and India commands a leadership position in that. So I believe the macro fundamentals of the country in commercial real estate are actually stronger coming out of the COVID pandemic globally than they were pre-COVID.
Ankur, it was a pleasure talking to you today. Thank you very much for joining us on Bloomberg Quint.
Thank you very much.
Best of luck for your read.
Thanks a lot.